Hi everyone, welcome back to Be Rich. It's me Vinod here recording remotely from Bangalore. This will probably be my last recording, though Sunday video I've already recorded ahead. So that'll be coming out tomorrow, but I'll be heading back to Chennai tomorrow. So this is the actual last video I'll be recording personally here in Bangalore. So those of you in Bangalore, I'm sorry I couldn't meet you. We are planning an event on a much larger scale because many of you were very positive about meeting me. So I've convinced my brother also to come down. So probably try and do 2 events in May sometime, which we will get to announcing dates closer to May, that is, once we get through April. We are planning on it. We have my team working on this. That said, what did I want to talk about today? Today I want to talk about gold. Gold has broken the barrier. It went above $3,000 and it was there for a little while above 3,000. Then it closed yesterday around 2,993. So that shows you where we are in terms of the world and the amount of fear which is there in the markets thanks to the tariff. But I wanted to give a larger context to this whole thing about buying gold, because a lot of you have been asking me on Instagram if you should be buying gold since gold has become such a valuable commodity and gold prices are going to go up thanks to the uncertainty in the market. So I thought we'll talk in context about gold. But before I get into the context of gold and if you should be piling on lots of gold, why my opinion that slightly differs from a lot of other people, I wanted to talk about what's happening in the news first. RBI interest rate, everyone's hoping is going to be cutting interest rates thanks to the expectation in the market and the tariffs. But I don't see that really happening because inflation in India is still very sticky. And if you look at the dollar rupee arbitrage, that is also something RBI is looking at. So looking at all that, I would probably don't see RBI cutting interest rate. But I can't predict these things because RBI I'm not. I'm just a small retail investor, much like you, who's trying to understand this. But the expectation of an RBI interest rate cut is there prevalent in the market. Well, in terms of what the foreign institutional investors are doing, I wanted to give you an outline on if you've been thinking this is the worst we have seen. This is not the worst we have seen. During the global financial crisis, which happened in 2007, it lasted in Indian markets from Jan 2008 to March 2009, just over a year. The foreign institutional investors pulled out $15 billion worth of money out of India, while the Nifty went down by 57%. Of course, those were the days before the domestic institutional investors and the retail investors in India were mature. So that means most of the price movements you saw in the market, such huge price movements, was thanks to the foreign institutional investors. Then, of course, we had the post-COVID de-risking, as they call it. That lasted from October 2021 to July 2022. Where the foreign institutional investors pulled out $35 billion, while the Nifty corrected around 10%. Of course, if you combine the lockdown crash which happened, which is about the same time, a year before, which was from Feb 2020 to May 2020, $9 billion was pulled out by the foreign institutional investors and the Nifty corrected by 23%. So from there, that lows of 2022, we saw the bull run, which took us all the way to 2024. This bull run which we experienced was a long bull run and it's pretty much come to an end. Till the next bull run will probably be a new bull run. It will not be counted as an extension of this bull run because the current market where we're looking at right now, the bear market, started in September 2024 and the foreign institutional investors have pulled out $27 billion so far and the Nifty is down by 15% so far. This is the current one. It's not over. We do not know when it's going to end, but it's running. Looking at the amount of months usually it runs, usually these bear markets last for a year or a little more than a year before we get into a prolonged bull run again. So if you're looking at it that terms, we at least have another, I would say, 6 months of pain before we can really say we have come to some kind of a conclusion in this. But then again, these things cannot be predicted. Meanwhile, globally speaking, the UK economy has been shrinking slightly, which has led to some alarms there, and you can read the news about that, and their finance minister and their politicians are up in arms about that. And meanwhile, in the US, the Fed is worried about stagflation is when the economic growth is faltering and is going down, while inflation seems to be going up. That is known as stagflation. That is what the Fed is worried about in the US meanwhile. So coming back to the topic I started off with, which is about gold. So this kind of gives you the scenario where we are. Of course, in the middle of all this, Trump tariffs are also all being played out, and the Europeans and the Canadians and the Americans are all at loggerheads with the Chinese in the mix. So this is what has been pushing gold prices up mainly. So if you had invested in gold in 2000, right, that would have been $278, and today it's up to $2,993. That's almost a tenfold increase from 2000. A lot of you can be thinking, wow, that is phenomenal. If it's gone up by tenfold, I should have bought a lot of gold in 2000. So I wanted to draw some comparisons and say why in the long term stocks always win over gold, and why even Warren Buffett doesn't buy gold. If gold has gone up at that rate, that is a CAGR compounding at around 10%. I know that sounds like a lot, right? Sounds much better than an FD. Most FDs in India, even now, usually end of the year, financial year, the banks reach out to customers trying to entice them by saying, I'll give you 0.5% more if you put it for 400 days, if you put it for 500 days. You've seen those ads. I'm sure a lot of government banks are reaching out to all of you, asking you to put some FDs, offering some kind of stellar returns if you're willing to keep it for a bit longer. So gold was even beating that. I understand that. But let's say you had looked at something in India like an ITC. ITC back in 2000 was trading at 12 rupees a stock. Today it's at 412. I didn't pick any fancy stock like a Tata stock and talk about that, because then you'll think I'm being biased. I wanted to pick something which is like a standard staple in Indian stock market, which is ITC. A lot of people like ITC, a lot of people don't like ITC. A lot of people think ITC is a great company and will keep giving returns. A lot of people feel that ITC is a slowly moving stock. It really doesn't grow explosively. So that's why I picked ITC. And if you take that alone, just the price of 12 rupees to 412 rupees, that is a CAGR of 15.8, right? But we do know ITC, unlike gold, does bonuses, it does splits, it does, rights issues. So if you factor all that in, right, the CAGR, if I had bought one stock of ITC, today I would have 45 shares of ITC. One share, if I had bought in 2000, thanks to bonuses, splits and rights, today it will be valued at 45. If I multiply 45 into 412, that is, and do the calculation for CAGR all over again, 12 rupees to now, that is a CAGR of 35%. Gold is at 10, right? If I'm looking only price to price, that's at 15.8. If I calculate with the bonuses, splits and rights issues, I'm up 35. Now let's throw in ITC hotels. I'll be holding 45 shares of ITC, and I'll be holding on to ITC hotels, which are got during the demerger. And if I factor all that in, my CAGR even goes up slightly, goes up around to 36 to 37. So that is the power of stocks. And even if you look at an American companies, let's say you look at Microsoft, which was trading at $31 in 2000, which was right near close to the so-called boom of the dot-coms at 31, and now it's trading at $388. That is a CAGR of 12, which is still better than gold. I have not even calculated the bonus rights and splits. I'm not even plugged in the dividends which these companies would have paid out. So if you look at it in the long term, gold is not a great return of wealth. You cannot build phenomenal wealth using gold. What you can do is, like I said in Instagram, during turbulent times, it helps you to stop erosion of your capital. So having in turbulent times, like now we're in the middle of a bear grip and the global situation the way it is, stockpiling on gold of 10% of your portfolio should be more than adequate. If you're stockpiling more than that, what will tend to happen is you will not see the returns you were hoping to see 10, 15 years from now. And a lot of my viewers are youngsters, and you can take on some risks. If you're older, I understand. You're nearing age of retirements, I understand. Your outlook has to be very different in preserving your nest egg, preserving your capital, preserving your corpus, as they say. But if you're younger, like my viewers like Dana and his cohort, I would say, please do not stockpile gold too much. Yes, buy gold, definitely. But don't see gold going to 3,000 thinking, oh my God, I'm missing out something. One of you viewers was very upset that a few days back he sold off all his gold Bs, and now his gold has gone to 3,000. He was saying, oh my God, I'm feeling terrible. I did console him and tell him, remember the reason why you sold it, and that should make you feel better. This is why the main reasons I say do not follow market news too closely, too critically. For the simple reason, if you do that, you will tend to get yourself into a psychological tailspin where you're having all kinds of nightmares and dreams which may not be true. Even I said in the Instagram when we were talking about portfolio and portfolio value, anything which you imagine, let's say even when you're seeing your portfolio, so-called portfolio down by 10%, 15%, do remember it is not your actual portfolio value. It is an imagined value if you sell today. And if you're not selling, you have not made no loss. And that is a fundamental thing a lot of you forget. You have not suffered any loss. Like how in the middle of a bull market, you have not had any gain. You do realize that only if you sell it, you're going to see that gain. It's a potentiality which you're seeing. Same way in the bear market, as long as you're not selling, you're doing fine. Do remember that in the middle of all this news and noise which you're hearing around you. Anyway, I do hope you have a wonderful Saturday evening. I hope I gave you some clarity when it comes to gold and how you should invest with gold and how much gold should be in your portfolio. I would love to hear your thoughts and comments. Do put them down below. Me and my team do read them, and I'll try to give you some feedback on this. Sometimes on your comments on YouTube here, I do give the feedback in Instagram, especially in our group. So if you're in Instagram and you can join our group, join me there. We do have conversations. I do take your comments and paste it there. And we all debate on what is the view on what the comment was. What is the general opinion on it. I don't try to say I am any kind of guru here trying to teach you anything. I'm also a learner much like you, just trying to share whatever I've understood so far with the vast majority of you who watch this. Thanks for watching the video again, and I'll see you again from the studio in Chennai on Monday. Have a wonderful Saturday and be safe out there in all your funs and revelries. I keep hearing so many terrible news about youngsters like you going out and having way too much fun and then getting reckless and careless and then regretting it the next day. Please be careful. If you do decide to have fun, do decide to stay there for the night and get up the next day morning and then make your way back home. Nothing else more to say. Have a wonderful weekend. See you on Monday, and it's the start of another week. Bye.